Today, the topic is about data analysis and ESG rating. I would like only to make a couple of remarks before talking about the data issues. We are asking ourselves if ESG is a strategy or if it's something that today you need to do in any case. So in slide 2, in these days, there is a lot of discussion also about the flows into ESG products, if ESG is able to beat the benchmark and the indexes also in times of COVID-19, etc., etc. So ESG into passive funds, blah, blah, blah. So looking at the first sight on these topics, ESG looks like a new investment strategy. But actually, our belief is that no, it's not a new investment strategy. It's not something that an asset manager can claim. So I am investing with ESG. No, you must invest using also ESG data into your process. And if we go to slide 3, also here we try to ask ourselves which is the right ESG strategy. So we can talk about why we believe that ESG is not only a style of investment. You will find that in every asset manager does have a style. So we are value investor, there are growth investor, there are GARP investor, there are investor which uses factors, there are quant investor. You have a lot of different investors, but even in ESG you will have different styles. So styles can be exclusion, can be using external rating, can be introduction and implementation into the evaluation of ESG ratings, raw ESG data, can be used into risk management. So we believe that every asset manager will choose the most appropriate ESG implementation and strategy based on the experience and especially on the skills that every analyst and every portfolio manager and every need of the company will have. So the concept is that there is no magic recipe to ESG. We are not here to say that ESG is the best, ESG, I don't know, exclusion, best in class or whatever is the best strategy. We will see a lot of different ESG strategies, and we are not here to say which one is the best. Of course, we believe that we are using the best approach, the most right approach, but time will tell. But there is always a but. So here today we are talking about data. So on slide 4, we talk about the issue of data. I don't know your job, but my job and the job of a financial analyst in these days is overwhelmed by data. So we spend the day in front of screens looking at numbers. We have several platforms, Bloomberg, Refinitiv, Reuters, DataStream. I can tell you 1,000. We look to financial data, we look to different kinds of data. So we are totally overwhelmed by numbers and by raw data. So we all hope to have a screen, to have a clean desk, to be able to manage all these different kinds of data. But when we have too much data, the risk is to have a lot of noise and not be able to extract the most important information. So in slide 5, there is if somebody of you have ever studied computer science, one of the most easiest and common rules is garbage in, garbage out. So you can have the best model, going back to what we were saying before, you can have the best ESG screening data, you can look to everything perfectly, you can have dozens of PhDs working on the model, but if you don't put the right data, you will get garbage squared results usually. So data is, in my opinion, much more important than the model itself. So going to slide 6, I want to give you some examples and issues which we have met during the years. This presentation is it's more a talk from myself to yourself because we are still in the early days of ESG, so we will have a big future on this topic, and there is a lot of adjustment which are needed in the future. So more than giving you the results and some final remarks or whatever, we want to talk about, we want to give you the message that we are all working on this. It's an ongoing business, so please work you too on this kind of stuff, because the industry in general needs a lot of new information, new ideas, etc., etc. So some examples of what we are seeing, we have seen, and we will probably see. So staying on the topic of COVID-19, which is the most up-to-date topic on the mouth of everybody. What I am expecting next year is a lot of distorted data. So a lot of companies, for example, will claim that they have reduced CO2 emission. Okay, fine. But if you have closed for 2 months your plants because there was the coronavirus, who cares? So it would be very interesting to see what will the company say to the market in absolute terms, because we have to understand that this is a recession year all across the world, and the data will be distorted by what we have seen on the pandemic diffusion. The other topic or the other issue is the not comparability of some data. So as of today, I have to say that if we take the most important stock, so companies, so the top 200 of the S&P 500, the top 200 of the Euro Stoxx 600, I have to say that the data is quite comparable sector by sector. But if we go beyond that, especially on the mid and small cap arena, we find a lot of data which are not comparable each other and are not consistent. I was talking with a company some weeks ago, and they weren't able to talk about scope 1, scope 2, and scope 3 CO2 emission. So just to give you the idea that when we go into companies which are not so careful about ESG issues, there is a lot of confusion even for them. Then another of the biggest issue we find is the topic of the limited updates. So most of the data we gather for the ESG analysis is based on sustainability reports, which are issued every year, usually. If you think about it, we are looking now in the month of May on data which we're referring to last year, 2019. Since then, the world has changed. So these first 5 months of 2020 have seen a lot of changes, and the pandemic, the technology, a lot of changes in our habits. So 5 months is a very long period as of today, while maybe 10, 20, or 30 years ago, 6 months was not so important in terms of time frame. Now everything happens more frequently, more quickly, and we need more data. Before I was saying that we are overwhelmed by data, there is too much data. In reality, we have a lot of data, but most of it is useless. We need more frequent but relevant data, material data. And finally, we have seen also cases of random data. So the data that the company are reporting on ESG topics are not the results of the work of the management or some policies or whatever. It's just that they happened like that, and the company took them as a result. So that's why we believe that data is important, but it's important also to understand how we get to the data. We want to make an example comparing what we do as a value investor in terms of financial analysis and what we do in terms of ESG analysis. So our job as a value investor, as you can see in the guide, is to identify the competitive edges of the company. So, and to buy them when there is a big discount on what we believe being the fair value of the company. So on slide 7, you can see that in terms of value investing, we are doing that. So financial data are the results of competitive edges, competitive advantages that the company have mixed with a good management. On ESG, we want to do the same thing. So having good data and good results must be the outcome of correct procedures, correct strategy, correct ideas of the company, mixed with a conscious management. Here, we are not talking about good management or great management or whatever. We use the word conscious because it's important, in our opinion, that on ESG data and on ESG issues, the management of the company must understand which are the proper issues to manage and the data to check instead of a generic being good or being great or whatever. Here, what you can see is that in both kind of analysis, on the financial analysis and the ESG analysis, the only word which is repeated twice is management. So people is more and more important. Is important on financial analysis and important on also on ESG analysis. Probably it's even more important. I always like to say that economics is not mathematics, but it's a social science. So people is very important. So to go on with what we do in terms of ESG, in slide number 8, our approach is, of course, starting with the raw data. We use the raw data because we want to have the less manipulated and the more clear data available on the market. And we produce an internal rating. We use the SASB materiality map, which Nicolai Landi will explain later, and et cetera, et cetera. But more important is that our model, it's important the message we want to give. So we want to go beyond the numbers. We go beyond the numbers on financial topics. So we want to understand why the return on equity of a company is better on the other, why the sales growth is better, et cetera, as part of our value investing. On ESG, we also want to understand if the company is having good metrics for the right procedure, the right consciousness of the management and everything, instead of greenwashing or looking to the best data or the most important topic where the market is more interested in every single moment. That's why we don't want to exclude, to work on exclusion for the lowest, let's say, internal rating score, but we wanted to talk with the company and to understand what is their strategy on ESG topics, to understand if they are aware of what we believe are the most important topics, and if not, if there are other topics, or et cetera, et cetera. So we are spending a lot of time meeting the companies. I can tell you that while until something like 3 years ago, 100% of my meetings were dedicated to financial questions. So what's your expected sales growth, competitive analysis, et cetera, et cetera. Now, something like 30–40% of my question and my time spent with the companies are on broader ESG issues. My personal opinion also on what's happening this year is that the S, the social, will become more and more important this year more probably than E and G, which were the most easy to analyze, the one with more data available. So that's what we are doing, spending a lot of time talking about that to understand what's beyond the raw number that we get on any kind of database. So concluding on slide 9, who follows Banor probably have seen these several times. So it was written by Professor Serafim and Gabriel Karageorgiou in 2017, so 3 years ago. Looks like a lot of time, but these words, in our opinion, are up to date. So ESG analysis will not replace financial analysis, like machine learning and fintech or whatever will not replace portfolio managers. However, managers who leverage ESG data along with financial data and utilizes technology advancement will replace those who don't to define active investing 2.0. So the message here is we are an active investor. We do a lot of work deviating from the benchmark and investing with a value investing approach. We are doing the same on ESG. So we are using a lot of ESG data in our financial analysis, and like what we do with the value investing, we go beyond the numbers. We want to see the management and to understand what they are doing on ESG topics, and to understand if the final data is the outcome of a good process and a good management, or if it's only random or dictated by casual.